Awesome. Everyone, welcome to our July webinar with Ablorde. We'll get started here in a second as people filter on in. This question always comes up. We do record these, so we'll send out the recording to everyone here as well as the recap. So be on the lookout for that as we get that coming in and sending that recap out. Just let me make sure I got the recording here going.
Yeah, I can see the recording on ours.
Cool. Awesome. So we'll get the recording out to everyone after we wrap the webinar. And please feel free to jump in with any questions you guys might have. Really excited to welcome Ablorde today to the webinar. Really going to be talking about the venture stack today. So for a lot of you that might have joined in previous webinars, we spent a lot of time with the founder mindset and the founder mentality. And today, really spending some time on the investor side of things and leveraging the expertise that Ablorde has, both being a past investor himself and now building tools for investors and digging into some of the things around the venture tech stack. So yeah, I mentioned really excited to do this today. I've known Ablorde now for a couple years, and just some background, and let me know if I messed any of this up, Ablorde, but grew up in Texas, went to Harvard, then from there jumped into the consulting world. With Bain for a couple years. For a good part of your kind of start of your technology career was part of the investment group and investment team at Pritzker. And then now founder of 4 Degrees, building relationships intelligence and CRMs for investors, private equity, real estate. And I believe you're also a mentor and advisor to a lot of Techstars companies as well. How did I do with that?
I should just take you around and let you do my intros for me, because
I could be your hype man.
That was far more concise than I typically give it, and it covered everything. So there we go.
Awesome, and call Chicago home now as well. Is that correct?
Yep, that's correct. Chicago's
awesome.
Home.
Awesome. Well, yeah, really excited to jump into this today. And for people that are just joining, great to see some of our customers on here as well. We will send this out. So we'll send out the recording, we'll send out the recap and highlights, as well as any resources Ablorde and I talked about. You can find Ablorde's Twitter and mine below. How is the Twitter game, by the way? Strong?
Yeah, I believe my Twitter game is pretty strong. I don't know about yours, but I'll let the group decide.
It's weak. Mine's pretty weak. I ebb and flow with Twitter. It's like sometimes I'll tweet a lot, and then sometimes I'll not say anything. But like VC Twitter is always, it's a contentious place to be. I don't know if I can handle those waters.
Yes, there's a lot of memes flying around that I don't have time for anymore. So yeah, maybe back in my younger days when I still had hair.
Yeah, there you go. Well, today we'll cover the state of venture capital in the second half of 2020 here. Each webinar we've done, I think in 2020 has really had a different tune, and it's actually changing. It seems like by the month, from January to February to the beginning of COVID, the middle of COVID. Who knows where we are in COVID now? But I think Ablorde, we were talking about this yesterday, has some interesting thoughts with where venture is. We'll cover that. We'll talk about how to use technology to build relationships and how you can use those to source deals, and really the core of a lot of what Ablorde has built at 4 Degrees and some of his experiences there. We'll jump into best practices for managing potential investments and managing those relationships. We will cover for founders, like where do I fit in all of this, and how do I think about building my relationships with investors and potential investors. And then this is something new. We're just going to do a quick 5-minute demo of both 4 Degrees, and we'll jump over to the new investor product that we rolled out in the last 12 months here at Visible as well, specifically for investors. So we'll do a quick platform demos and wrap up, but I try to keep this to a tight 45 for everyone, and be respectful of everyone's time. Great. So what I want to start with, like, venture and just kind of get your quick takes of where we're at. I'll make sure to put this in the recap. You guys did a great survey here with the coronavirus and put some content together around where we're at. But maybe I'll just hand it over to you and just kind of hear, like, where are we at right now? It seems like July was like an insanely hot month for venture in general.
Yeah, no, it's a great question. And so to your point in the slide, we spent some time early in the shelter-in-place / COVID-19 era talking to a bunch of investors in the venture landscape and universe, asking some questions around what they thought or how they thought that COVID-19 was going to impact their own activity and that of their peers. And as we were looking at 2020 and 2021, I think most firms expected that 2020 was going to be a really rough year for funding. Right? And so that particularly the second half was going to take time for people to get adjusted to working from home, for like having conversations like these remotely, getting enough conviction to write checks, that there were going to be a lot of portfolio companies that were struggling as a result of being heavily reliant on the physical world and physical presence in order to generate revenue and ultimately grow the business. And so I think people thought, hey, we're going to hunker down. We're going to spend a lot of time with our portfolio companies. We're probably going to like titrate back the number of new deals that we do, both in terms of size, but also the valuation of those deals and the overall volume. And maybe by the end of 2020, we'd be back to a position where things felt close to normal and more likely into 2021. And I think that was the narrative that most of us believed, and that certainly the set of investors we talked to articulated. I think what we've seen, particularly is towards the end of June, and certainly a lot of the anecdotes I'm hearing in July, is that July has been an incredibly busy month for a lot of VCs, ones that reflect, maybe February or early March of 2020 in terms of overall like volume of deals being done, or at least coming inbound, and the amount of competition for the deals that feel like most attractive or most hot. And so I wouldn't be surprised if there's a little bit of a bifurcation there where like the best companies have a lot of capital chasing after them that has mostly been on the sidelines for the past few months, but people still have a mandate to deploy. And so maybe that's kind of creating what feels like a frenzy for certain kinds of companies. But in general, most firms I've spoken with over the past month have just remarked how crazy it's felt or how crazy it's been. And so I think there's been, maybe a more limited impact that COVID has had on that activity than I think all of us anticipated. We can certainly speculate for a bunch of reasons as to why that might be the case, but in terms of the brass tacks, that's probably what I would point out.
That's super interesting. I think call it April timeframe, and maybe early May, there was like this idea of like COVID winners and losers, right? Where these companies that were quote unquote essential and think delivery, stuff like that were getting funded. Is that what's happening in July, or is July kind of just like business as usual? Not business as usual, but these are the types of companies we were seeing in February, and COVID winners and losers are not even a thing anymore.
Yeah, it's an interesting question. My view is, to your point, early in COVID, you probably said, hey, there are these remote collaboration tools or other businesses that really thrive as a result of being like work from home. And so those businesses are going to get funded at, really high multiples. But then businesses that historically would have been able to raise like pretty strong venture rounds are now in a little bit of a desert, right? So people are less likely to do deals. And so the companies that were on the margins of getting deals done are going to have harder times doing so. My sense is, my interpretation of what I'm seeing is that's no longer the case, or at least that story doesn't seem to be holding fully. And so the way I think of almost like the set of companies that are out there in the markets is there's probably three buckets. There's bucket one, which are the folks who get accelerated via COVID. I think in either one of these scenarios, they're fine. I think there's bucket two, which is the companies who are drastically harmed by COVID. So again, the companies who are heavily reliant on the retail or physical world. I think both of those are still hurt regardless. And I think the third bucket are your average, or maybe not average, but the vast majority of companies where, they're probably were at 1.80 to 90% of where the business was historically, but still growing, still making progress. And my sense is those businesses are still getting funded today, which isn't something that I think we would have predicted. And I don't think like a lot of the blog posts and quote unquote thought leadership would have predicted either.
Really interesting. And this stat you guys have around 74%, venture will decrease over the next few years. Is that a general macro sentiment absent of COVID, or is that, because of COVID? I'm just curious to hear, like, do people think it's just going to decline in general because we're at just such high peaks, or what is the thought or thesis behind, that pretty large decrease with the venture number you guys sourced?
Yeah. So that's specifically, my guess is it's more related to COVID than anything else. But the thought process is, hey, the volume of deals, the amount of dollars invested probably is going to slump for at least the next like year or so, at least in most people's opinion, because we were heading into this kind of uncertain era where a lot of companies were unfortunately going to go under, and portfolio companies were going to be struggling, and people were going to need to hunker down. And so far, if July is any indication, certainly 2020 as a whole is not going to be as strong as 2019 was. But I think if you were to like extrapolate what July looks like for the rest of the year, I think it would be, very much on pace with prior years.
Do you guys have a plan on trying to do this survey in the near future, just to see how the data compares to when you originally produced it?
Yeah, definitely it's definitely something worth revisiting, right? Because I think even now we've already seen just how dynamic people's actual actions and participation has been relative to what they thought it was. And so I wouldn't be surprised at all that we get very different results if we run this again in the next quarter.
What about first-time GPs and new funds? Like for the longest time, you kind of heard this story over the past couple of months of it's gonna be hard for new funds to pop up and get LP money, especially institutional LP money, and that also seems not to be the case. I think every day you're reading about net new funds joining the space. Have you guys seen that with your own customer base or conversations you're having?
Yeah, I mean, I certainly have heard of activity on that front. I do think it is harder. And I think it's harder for a few reasons, right? So one is I think lots of limited partners see these as long run relationships, and particularly ones where they want to be forming them in person. The average LP relationship lasts longer, or say LP GP relationship lasts longer than the average founder GP relationship. And also the amount of dollars that are being deployed, generally speaking, is a significantly larger number over time. And so because of that, you see LPs wanting to have these longer run relationships that are harder to form just over Zoom. And so I believe that impact still exists. I do think there are some other countervailing forces that are also muddying the narrative though, right? So number one is I just think the cycles for those are really long. And so if you were an LP looking to make 3 commitments to new GPs this year, chances are by like February, you already knew who those 3 were, right? Or at least they were already somewhere in your process. And so the extent that we're seeing funds closing or announcing that they're up and running and for business, there's a significant lag effect. I think we've known that's to be true. That's even true of like startups and GPs, but I would argue it's significantly more true in the LP GP relationship. I think the second impact is I think there's a lot more like high net worth individuals and family offices and the like who are participating now as LPs and kind of funds. And so those investors are a little bit less constrained by people's typical timelines and decision-making processes, and so can move more quickly. And so some of the funds I've heard of are not actually LP or institutional LP backed. They are, family backed. They are a number of individual high net worth backed. And I think that is probably another dynamic that muddies the waters here a bit as well. So in short, I suspect the underlying truth of what you said is still there, which is that institutional LPs take a long time to make decisions. But I do think there's some other things that make the picture we're seeing at the moment of announcements be a little bit more muddy.
Yeah, fantastic. I think that makes a lot of sense. And last thing before we move on here, I think we saw this a lot in April and May, where we were getting a lot of inbound from investors saying like, I'm really just digging deep in my current portfolio companies right now. I really want to spend time getting tools and processes set up for managing those relationships and how I can best support my portfolio companies. How are you seeing that play out as well with how investors think about their current portfolio and set of founders versus potential investments?
Yeah, I would say in late March to early to mid-April, a lot of investors were in triage mode, right? Which is we need to look at the full portfolio. We need to understand who's likely most impacted in a COVID, like in a scenario like COVID. And we need to determine who is in dire need of cash, who can likely make it through, and what options are available to help the companies that we can support to make it all the way there. And so I would say that was a big focus of people's time and attention. And so I wouldn't be surprised if tools that helped investors keep better track of what was going on with portfolio companies and easily understand those metrics and report against them, likely had a real boost. And so hopefully that was you. And then my sense is that come, call it May, people started to become a little bit more back on the offense. And this whole time, people were still taking pitches and having conversations. It's just that, one, the bar to do a new deal was much, much higher. And two, even where they were digging in, like the level of diligence required and conviction was just like extra normal. I think in May, people started to go back on the offense, particularly for deals that they felt were interesting and had some level of heat around them. And really for us, I'd say by end of June, my perception of even the conversations I was having with investors about products like ours was just on a very different level. It was back to February.
Yep. Yeah, cool. Well, appreciate the work you guys did to put this together. I think it's a great resource. We'll put that in the recap. But enough COVID talk for the day. I think it's important. I mean, I always joke like, man, aren't we tired of talking about it? But it is important. It is reality. And it seems like it's been reality for a while. But let's move into the fun stuff. And something I think both me and you have a real passion for today. That's relationship building and using technology and how do you use technology to build those relationships. I grabbed this off your site. You guys have this, matrix of, sourcing deals and warm and cold and outbound and inbound. And we can run through some of these questions, but maybe the first thing I was just curious of is, as a GP or investor, how should I think about my outbound versus inbound mix, right? Obviously I'm in the beginning inbound, but like, are the best deals outbound? How should I think about building that outbound network? So let's just start with like the outbound and inbound mix and best practices there.
Yeah. I mean, I think the honest answer is this is very kind of firm dependent, and it's dependent on your strategy. It's dependent on the stage at which you invest. And I think all of those have kind of important implications for which mix or where in this set of options you fall. In general, I do think it's important to have both. I do think focusing only on inbound means that you are going to be constrained to the set of deals that are in some way, shape, or form in your network. And there probably are really good deals in your network, and you probably aren't capturing all of them. So certainly there's an opportunity to think very strategically about how you might kind of entice or build those relationships with people such that they are sending you the best companies that fit your thesis and areas of focus. But I think one of the realistic truths about venture is that, and for any given year, there are only so many companies that ultimately will become large venture scale exits. And chances are a good chunk of them aren't in your direct network, or at least aren't going to come to you if you do not. And so if you see that as a truth, then it means that you do need to be either taking in or looking for some form of outbound outreach to companies that you find interesting that meet your criteria in order to ensure you're at least seeing all of the relevant deals that could kind of fit your mandate and be one of those large scale outcomes. And so I know some firms that are heavy on outbound and who have large teams of associates or analysts or what have you, who do nothing but identify companies and reach out to them to make sure that they're getting as full of a coverage of the world as possible. There are other firms who have none of those professionals and who only sit back and take deals from the folks that they know. I think both have weaknesses done independently, but collected, they are a strength. So to answer the question in maybe a little bit of a the standard "it depends" format. Those are those are some of the considerations I would have as I thought about that question.
How talking about maybe a firm that does just inbound or relies on a lot of inbound, but outbound being an important part. Like, how to create leverage there? Like, how do I think about maybe trying to introduce a little outbound? Maybe I don't have a ton of resources. Is there a way I can get some of that mix into my firm where I'm now creating an outbound rhythm, but I can't go employ 5 associates to go build relationships?
Absolutely. I mean, I think there's a spectrum of the level of effort you might put forth in outbound. And so when I think about having 5 or 10 associates out doing a bunch of outreach, those are, one, to your point, they're going to be larger funds with a lot more resources behind them. But 2, I think their strategy is to cover every possible thing moving within like the sectors and spaces where they spend time. Whereas I think for most organizations, even for a team of 2 or 3 people, one of the most direct ways or most straightforward ways you could do outbound is to try to identify where there are deals or companies that exist that people in your network have access to, but they haven't proactively shown you. Right. So an example of that might be if there are co-investors of yours who are invested in companies that are also in your space, but they just didn't like send them your way. One of the things that we've actually seen a number of funds we talk to do is say, hey, here are a bunch of funds we really respect and like who are like a stage ahead of us, or here are a bunch of angels we know who invest like, again, a stage ahead of us, whose judgment we really like and respect. I just want to make sure I'm staying on top of the deals that they're doing. Because if those companies are doing well, and especially if they haven't been proactively introduced to us, I want to make sure I'm able to get in front of them and have a conversation to make sure I don't miss out on this opportunity should it exist. And so I tend to think that's like the most straightforward way to begin, is leverage the existing base of ties that you have, understand where those people are spending time and attention, and then if you trust their judgment, try to ask them for introductions proactively to companies that could fit your mandate.
Yeah, that makes a ton of sense. I want to talk about cold as well. On Twitter, and this is getting a lot of attention recently, and I'm glad it is. There's really a big focus on unrepresented founders, and specifically, maybe I don't have the amount of relationships that someone else might, and venture needs to be accepting of getting cold inbound and receiving that, right? Maybe not through a quote unquote traditional channel. What are some ways you think that investors can kind of think about being receptive to cold and using technology to help with processing some of that cold inbound or people coming to you as a GP?
Yeah, I mean, so when I think about at least the stated reasons for why people spend time on mostly warm inbound or try to essentially avoid cold inbound, is usually because there's no like clear quality or like trust filter on top of those inbounds, right? And so you get a lot of variance. And for in an industry where time is valuable, that variance, and particularly often the low end of that variance, means that channel can be one where it's painful to spend the limited time that you have. Now, I do think one, it really is to some extent like a social justice issue, because there are a lot of folks who just simply don't have access to the network of people who know you. And so that leads to these large systemic consequences that people are right on Twitter to discuss. And so I do think if you're going to accept cold inbound, which I think most funds should, you need to figure out a different way of identifying quality and identifying what you can trust that then allows you to sort through what is a large volume of cold inbound to a set that maybe we're spending more time and attention on. And I do think technology can play a really important role in doing that work. So first, naturally, is getting the opportunity to see like who this person is and what they've accomplished in their past. So being able to quickly pull up, hey, with this person, what prior roles have they been a part of? What accomplishments have they had? I think that's a very quick way of starting to be able to understand some of that information. I think a second way of starting to understand and gather trust is using other filtering mechanisms outside of just who sent things to you. But maybe it is like being able to easily pull out data around traction and markets, which technology is well suited to do as well. That can help you more easily filter down this broad set of potential inbounds into a specific set of companies you find most interesting. So some examples of stuff I've seen specifically in that second domain are like having open application forms of sorts, where instead of having someone just send you an email, you are asking for the structured data points that enable you to instantly understand, one, is this company in my thesis? Two, do they have like the requisite level of traction or focus that fits where we spend our time and attention? And so doing those things, I think, allows for a more structured approach to cold inbound using technology that gets you to those sorts of results.
There's it's Kinetic Ventures in Covington, Kentucky. I think they do a really interesting, they've been doing this for a while, where they're looking at kind of a qualitative assessment of the founder, kind of like a Myers-Briggs type, scenario, looking at traction about the market and other data points. And I think for the longest time, they were kind of seen as like this black swan, if you will, where people are like, why would a founder, go through all this work? But what they're doing is actually pretty interesting, because it's like removing a lot of the bias and some of that. And I think we'll see some more of that.
Yeah.
And yeah, it's just interesting to see how that might change where you are like applying to things as a founder now. Earnest Capital, which is a little bit different, not traditional venture, but I think they're doing some pretty interesting things around bootstrap SaaS. They launch this product called Trailhead, where a founder can kind of just get up to speed about the fundraising process and learn about it along the way. And so I think there's a lot of efforts being made here, which is exciting to see about how a firm can be receptive to receiving things cold.
Yeah, and I think an important piece of both maybe the structured format that I was describing, but also what Kinetic is doing and what Earnest is doing is, I think there is oftentimes a bit of gamesmanship in the fundraising process where you both need to know like these unspoken rules of the game as well as like actually build a great business. And I think where a lot of the opportunity lies in cold outbound is being able to try to like separate those things. So basically say, I don't need someone to come into this with a perfect warm introduction or with a perfectly formatted email that's structured exactly the way I like to receive emails, or all these other like I guess pieces of the canon that are known to people with networks and people with access, but aren't necessarily known to others. And I think in doing so, that actually creates an opportunity for real upside. The other comments I would make on this point specifically is, again, we talked about venture being a business of outliers, right? So fundamentally, the job is to identify these companies who can scale 10x, 100x from where they are today. And to the extent someone is an outlier, there's probably some level of correlation to someone being an outlier and someone being cold inbound, right? Because outliers are usually outliers in multiple domains. So with that, I'll pause.
Yeah. So somewhat related to that, I put marketplaces here in parentheses, but there's this, are good deals on marketplaces. When I say marketplaces, I'm talking everything from like called the AngelLists of the world to even just like kind of private curate, even at Visible, we do some of this, right? Where you're kind of curating deals and kind of doing almost like a Tinder double opt-in, like, hey, yeah, I'm interested in these types of companies. And then when you get a founder, and like, hey, we kind of have a match here. But there's also this like stigma of like, oh, if this company's on a marketplace or some other kind of third party, there's something wrong with that deal, right? Because it can't raise money the traditional way. They don't know the rules of the game, what have you. Like, I would love your take both from being a founder as well as an investor. Like, are there good deals on marketplaces? Should I even look at this for sourcing opportunities, or should I really focus on my personal relationships kind of first and foremost?
Yeah, I mean, there's I guess a couple of different components to that, so I'll try to break it apart. So first is, are there good deals on marketplaces? My instant answer is yes. And I guess the reason why I lean strongly in that direction is I think inherent in the idea that there is adverse selection, right? Because if these companies couldn't raise money, then that means there's something wrong with them, is a belief that you can essentially predict the future, and that everyone is so good at understanding collectively what a good company is that that can be easily understood, and that a consensus can be formed that is an accurate consensus. And I think the problem with that is there's so many counterexamples in the early stage or venture universe of companies that did not seem fundable, or that did not seem like great businesses that turned out to be the phenomenal businesses, right? You'll hear the stories of the founders of Robinhood talking about how they were rejected 150 times before they got their first investment, or a number of other cases that sound and look like that. And so if you don't believe that the consensus of a company is actually, the proper way to view its potential, then that, I think, by definition means that there are companies who are going to be outside of the normal sphere or normal fundraising pattern that are going to be good businesses. And a lot of those are probably going to be found or can be found on marketplaces. And so I tend to believe that it's incumbent on investors in a heavily competitive universe where there are more and more dollars chasing around companies than before, that you should be looking for opportunities wherever they exist, and chances are there are good opportunities on marketplaces, whether those are AngelList or particularly Invisible. I bet Visible does a better job than most. And so I say all of that as I would certainly believe there are good deals in marketplaces. That said, I think there are other dynamics around kind of relationships and relationship building that naturally mean that those are important too. Whether it is your capacity to get into the deal into the first place, particularly the most competitive ones, or identify these companies through other people. All of those can be very relationship driven. Ultimately, your investment in a founder is a relationship that lasts for a long time. And so I don't think you can completely cut out that component. I just say both have their place.
Yeah. Love it. I tend to agree. I mean, I do agree. I think it's just, I think we'll start to see marketplaces. This is some of the things we're thinking about at Visible, where you kind of have that person or person of trust, right? That helps broker the introduction and like layer, maybe 80% of technology can get you there, but I still want to have someone introduce me or have a party that helps facilitate the connection of company to investor. But yeah, I mean, I agree. I mean, Uber was on AngelList, so there you go.
Right.
Final question here, kind of a softball, but I'll throw it your way. Do I really need a CRM to manage like my relationships as an investor? I'm using my own homebrew system now. Like, why should I think about investing and using a tool like 4 Degrees and putting a CRM together for my business?
Yeah, I mean, do you really need a CRM? I think depends a bit on what it is you are looking to accomplish, the set of companies or the set of relationships you are trying to build and maintain, and ultimately how important it is that you stay on top of and engage those people. I would say for the vast majority of organizations, even once you get north of 2 people on your team, we at least see firms running into a number of specific challenges that we think a CRM can help solve well. So the first is a coordination challenge, which is, how do I know what other deals my co-founders or other partners that are spending time looking at, and thereby have a very clear view of what's likely to close, how much capital are we likely to deploy, what LPs we might be able to get into the fund to help us deploy the next batch of capital, all become really difficult to do, especially in an era where we're all sheltering in place without digital tools to help you keep that organized. A second challenge that we oftentimes see is honestly a lack of, kind of best way to describe this. It is a set of missed opportunities that come as a result of missing an understanding of who your team is connected to. We almost think of this as when you spend a bunch of time trying to help a portfolio company get into a Procter & Gamble, let's say, because there could be a really great customer for this portfolio company. You spend 3 or 4 hours calling in a bunch of favors and mining through LinkedIn and the like. And it turns out that your partner or your associate, their roommate worked in Procter & Gamble's purchasing department in the exact same place you were trying to get to. And one quick search in a system could have given you that answer, but because there were no good digital tools to give you that, you burnt a bunch of time and energy and probably called in a bunch of social capital that you just genuinely didn't have to. And so there are all of these sets of opportunity. Whether I gave a specific example in the case of a portfolio company, the same exists for deal sourcing when you're trying to get into a business you think is really interesting but are lacking connection paths in. There's all of this missed opportunity that exists in our day-to-day workflows, particularly as investors, that without a system that helps you understand and keep track of those relationships becomes really, really easy to miss out on. A third bucket that I've oftentimes seen people point to is just a recognition that the relationship network that they have is one that can send them deals and should be sending them more deals than they're seeing today, but they haven't been spending nearly enough time with those folks to strengthen the relationship such that you are top of mind for those opportunities when they come. And so systems we have particularly good systems like 4 Degrees, in my opinion, have an opportunity to help you maintain those relationships and thereby drive deals your way when the time comes appropriately.
That's a perfect segue into kind of the next slide here, best practices, right? In particular, I want to start with the second question here, and this is something I struggle with. It's how should I think about how frequently I should be touching base with people in my network, and then I think more specific to my problems or just the ways I think about this. How do I elegantly re-engage a relationship that might be getting stale, right? Hey, I met a board X months ago. We had an awesome conversation. No immediate way for us to work together, but just really enjoyed it. How do I go about just thinking, what are the best practice like engaging that person, right? Because what I don't want to have happen, this happens to me all the time, where 2 or 3 years go by, someone hits me up for it says, hey, I see Ablorde on LinkedIn, can you facilitate an intro? And I'm like, man, it's been like, I don't know, 3 years. Like I can try to whip something up, but it's not like something I can do. Like what are your I mean, you guys do this for a living, like what are best ways to just like kind of tap people on the shoulder and just kind of build a relationship, or just stay in touch with someone that you had a great initial conversation with?
Yeah. So maybe taking the first question, like how frequently should I touch base with people in my network? I think, again, I always give the natural, like it depends question, but I do think one way to think through this is you have, Mike, in your network, probably thousands, maybe close to tens of thousands of people that you know. It's unrealistic to think that you touch base with all 5,000 of those people, even on a yearly basis. It's just a lot of touch points, particularly when you have a business to run and a family and some semblance of a social life outside of work and the like. Is just a lot to expect of yourself or for any human. And so I think the first step is, who are the folks in my network who I either deem to be, important and interesting to me on a personal level, or that are valuable or strategic or somehow relevant to the business I do on a day-to-day basis, and then scope that list down to a more manageable set, right? And so oftentimes that list could be, a couple hundred people, could be 50 or 25 people, depends on how you operate and how you run. And then from there, I think you ask the question of, what do I need to do in order to either, one, strengthen this relationship to a point where I believe it is, strong enough and steady enough to last for the duration, or two, maintain it if it is one that already is at the level at which I desire, right? And I think each one of those have different answers to how often or how frequently you might ping that person, right? So in a case where you are actively trying to strengthen and maintain that relationship, you probably want to make sure you're touching base with them in some format at least once every couple of months, right? So once every quarter or so, right? Whereas if this is someone who you worked with at FormStack or at Visible, right? And you've been in the trenches with them on a day-to-day basis, those relationships, even if you don't touch base in like a year or two, chances are that underlying kind of shared experience and depth of experience is strong enough that it doesn't actually require as much daily thought process and maintenance in order to ensure that relationship stays strong over the long haul. And so it really does, in short, depend on what your goals are for that relationship and the existing state of it, that kind of, in my opinion, drive what cadence of interaction makes most sense. Now, I think across both this question and the second, which is re-engaging relationships that are getting stale, I think there's a real opportunity to do so with authenticity in both domains, right? And so what I mean by that is, if there's one thing saying, hey, we haven't touched base in 6 months, how are you? Which over time comes across as being super transactional or otherwise very mechanical, rather than something that came from like genuine feeling and thought. Now, if you said, hey, I read this article and I was thinking of you, right? And I was thought of you because, this tied back to this conversation that we had around your interests and why this is interesting. Or I read in the news that your company just raised a new round, congratulations. Or I read this article that you wrote and I thought it was really interesting and it made me think X. In short, for each one of us, particularly in these heavily relationship-driven industries like venture and kind of company building and the like, there are usually touch points. There are usually pieces of news or other signals that you can use to re-engage someone in a way that it doesn't feel, as formulaic or as transactional, but rather as a real opportunity to build on and strengthen that relationship. And that's typically what I would recommend in both of these domains, and especially in the case where you're re-engaging someone that's stale. If you have something that feels organic, something that feels natural, I think that's an opportunity to essentially get back into the door and start building on that.
Love it. I love the article thing as well. I think that's I love when people do that too, right? They reach out and say, hey, I saw this thing of you guys. I think it's really just an elegant way to do that. What about like, you mentioned top of mind, Dunbar is number 150. Do you buy it? Or do you think that something like a 4 degrees or whatever I choose can help me have more than 150 kind of relationships that can be on top of at any given time?
Yeah, I mean, my view is one of the underlying benefits of technology is to augment human capacity and human potential, right? And so in a world where there were no computing devices or other forms of technology, and technology in a lot of ways has taken many forms over history, you probably were constrained to 150 because that's what your kind of mental hardware has embedded in it, or at the very least, like the capacity that exists for that. I think 4 degrees, and this is maybe similar to an Evernote or similar to a Notion or your note-taking tool of choice, in that it becomes a second brain. But instead of that brain being about, this book that you read or this conversation that you had with a potential investment, it becomes a second brain for your team and your base of relationships. And in doing so, I think it augments the number of relationships you can actively maintain and strengthen and think about and access when the time is right, to a number far greater than 150. I don't know exactly what that number is, and I think over time we'll have enough data to be able to tell. And ideally, we'll continue to build more and more kind of pieces of functionality into our products, and such that number is ever expanding. But in short, I think if technology serves the role that it can, should, and does, then Dunbar's number, I think, is a thing of the past.
Love it. There's a question I think it's kind of related to my next slide, so I'm just going to jump over to the founder mentality here. Let's start with, we mentioned Outbound as a strategy, associates, cold emailing or calling founders and companies. And there's like a couple schools of thought here. I should be building relationships with GPs and GPs only and not associates. And so like, as a founder, how should I think about that? I mean, I know you were an associate, right? I think to start at Pritzker, and I'm sure we're trying to build relationships with like, should I, as a founder, be responding to associates and building relationships with them? Or is that just like a waste of time? And I should just be heads down building my business, because who knows what the intentions are? Maybe they're just trying to understand the marketplace or invest in a competitor. Like, for a founder, should I be spending time with some of this cold inbound that's coming away from, call it, an associate?
Yeah, it's another one of those questions that I think has multiple answers. So I'll give you both sides of the conversation from my view. So side one is, there are plenty of associates or analysts alike who are reaching out as like fishing expeditions of some sort, right? In some cases, they legitimately have quotas, like almost like an SDR or a salesperson that they need to hit for like number of new companies that they're talking to and data that they're able to throw into the CRM and track for the future. And to the extent that you can suss out that might be the motivation behind the conversation, I probably wouldn't take it, to be honest, right? Because it's clear that, what they have been tasked with is more of a data gathering exercise than a relationship building exercise, right? There are other associates who are empowered to actively source deals and bring them into the firm and advocate for them and influence decisions that are made in the organization. And so I think in those cases, there's an opportunity to take advantage of that, or take advantage of that outreach to begin the conversation and begin the relationship. And so a couple of things that I would at least personally look for as these conversations are occurring that I think help. So the first is their willingness to actually bring a partner into the conversation in some sense. Because if there's a level of seriousness about what it is that you're doing and they think it's interesting, they want to learn more, then I think you can at least ask, like, hey, I'd love to also meet, I read about this partner's experience and expertise. It seems super in line with what it is that we do as a business. Like, if you'd be up for the conversation, I'd love the opportunity to also have this person in as well. I think that's fine. I think that's okay. The second thing I would do is also look at what their personal portfolio looks like. And oftentimes that'll be on the firm's website or on their LinkedIn. If they've actively been involved in investments, that at least tells you that they have been spending time understanding some of these spaces and businesses. But also that they've kind of spent the time to build relationships with founders that have resulted in something, right? Rather than just being, someone whose job it is to throw data into the CRM. And so in those cases, I think it's valuable, again, to build a relationship. And the reason why I think it's worth it at all is oftentimes, these investments that are completed, particularly at the Series A, Series B, are done with founders that are known to the firm over the course of 6 months, 9 months, what have you. And Visible is a great tool to help people maintain those relationships between founders and investors. And so give them the opportunity to start building that relationship, to demonstrate progress and traction over time, and actually at like an individual one-to-one level, build an advocate within a firm that will kind of drive to make this happen when the time is right, is incredibly valuable. You just want to make sure that it's actually being positioned that way rather than as something else.
I love that. I'll make sure to put that in the recap. I love that thought, at least from the founder perspective. If you get a cold inbound and doing a little bit of research to try to loop in a partner, I think that makes a lot of sense, and can kind of quickly understand, is this person for real, or are they just trying to meet a quota and get my data into the CRM?
Mm-hmm.
Kind of related to that, and then we'll can't believe it's already 11:45 here. And then we can wrap and kind of do some quick demos here. As a founder, what's the best way to stay on an investor's radar? I think especially in the earliest stages, founders are used to hearing all the time, like, "Hey, hit me up when you have a little bit more traction," or keep me in line for the next round. Like, sometimes that's investors just trying to give a soft no. But sometimes it is real, and like, hey, you are kind of just early and we invest later. What are some ways that I should be thinking about staying on a company's radar, or sorry, on an investor's radar? And then I guess on the flip side, this is on the previous slide, like, as an investor, if I am actually curious, like, how should I think about maybe proactively pulling that information out of the founder as well?
Yeah, so I think in both cases, the underlying theme I'd point to is like deliver value, right? And so in the case of a founder, like talking to an investor and keeping an investor updated, probably actually the first piece of advice that I would have is to actually qualify that interest up front. So to your point, there are a lot of investors who will say, keep me in mind for your next round, or, too early right now, but keep me posted when you have more traction. And so I think it's one of the things that I've found to be helpful, and I've seen other founders do to great effect, is to ask, like, okay, like, what level of traction would be interesting to you, or like, what specifically are you looking to see, right? And I think that answer is illuminating for a few reasons. The first is, if the answer that they give you is non-specific, then that feels to me like more of a brush off, to be honest. If the answer to you is specific, but specific in a way that is totally out of line with how you think about growing your business, or is out of line with, honestly, like what you've already told them, then I think that's also another signal that's worth paying attention to. But assuming that the response you got felt reasonable on both those dimensions, then what I would do is I would try to figure out if there were specific kind of tactical updates to provide that were either showing your progress against those specific areas of focus that they've described, or are somehow otherwise like related to the growth and success of the company. I don't think this needs to be a highlight reel. I think most people are sensitive to the idea that when they are only seeing the ups and no downs. And so I think you should be honest and transparent when things do blip, because things will blip over the course of building a company. But I do think if there are specific news articles you've been a part of, or accelerators you've joined, or team members who you think will really accelerate the business in some format, or other notable updates, I would certainly use those as opportunities to engage that investor. I would also, I think part of the fundraising process, and hopefully when you talk to an investor, you get a chance to do this, is to truly try to start building a relationship with that person. And the reason why I say that is, like, even in the success case where you get someone to invest in the company, or someone chooses to invest in your company, you are working with them, if you're a seed stage company or a Series A company, for probably north of 5 years. And so if you get to the point where you are deciding to sign that term sheet or to accept that check, you want to have like real belief and faith that this person is someone you'd be excited about working with for that period of time. And that only comes through spending time together and actually building and forming that relationship. And so when I said like deliver value, some of the things I'm thinking through if I'm a founder are outside of just the, hey, here are my numbers. What did I learn about this person and what they are focused on and what's going on with their family, or any other more human details about them that I can use to build on the relationship? That's everything from like random pings on Twitter when they said something funny and we're responding to things, to, hey, read this article, thought it was really interesting and it's tied to your area of focus, thought I'd send it along. Or, hey, I met this founder who I think is really great and seems like they're potentially in your sweet spot, but would love to introduce you to them. or other things you know that are tied to their goals and objectives that I think will lead to greater long-term outcomes. And even in the case where that investor ends up not being the right fit for you when the time comes for whatever reason, that investment in the relationship will likely pay other dividends in the form of introductions to other investors, or maybe helping you get in front of customers, or other things you'd value. On the investor side, again, I think the answer is similarly to deliver value. And so some of the same things I was describing that investor could do in that scenario apply to you as an investor. So if you really like a company, you think it's too early, help them get the round closed that they're trying to get closed now through introducing them to investors that actually do invest at their stage. Help them get access to customers that could be really great logos for them, or otherwise help grow the business. Help identify talent who you think could be great additions to the business, and thereby help accelerate them to the point at which you are excited to invest. Help them connect to advisors or folks who have operated in those same spaces and have faced some of the same challenges that company is likely going to face to help them surmount those. I think there's no shortage of ways that you can prove yourself to be a great partner even before the money is wired. And if you as an investor really like the company and the founder, it's incumbent on you to take advantage of that and do it.
Love that. Yeah, one of our customers, I think she does a great job with this, with potential investor conversations where shows, hey, can I get introductions to these 3 customers or potential customers? And you kind of quickly learn how quote unquote value add an investor will be just based on that one interaction. And as an investor, helping facilitate those, maybe you don't even end up actually investing in that company, but you've kind of built a relationship for the long haul. And who knows how she might be able to provide a deal down the line, or even second company. So awesome. All right, so we got a couple. Oh, sorry, go ahead.
Yeah, I think both those points are right. I think it's ultimately about moving the investor-founder relationship away from the transaction, that is the signing of docs, to a relationship, and that relationship could result in an investment one day, or that relationship may have myriad other benefits, personal and professional, that can benefit both parties. And I think if both sides approach conversations in that way, I think we're in a better ecosystem as a result.
Yeah, I love it. Okay, so we got a couple minutes left. I would love just to do a 3-minute demo if possible. That's gonna be a hard task, I think. Well, we're gonna try to do 3 and 3.
Yeah.
And I'll hand it over to you about how to do 4 degrees first. I'll do visible, we'll wrap. If people want to get a full demo or check out 4 degrees, where's the best way to book a demo with you or someone on the team?
Totally. Go to 4degrees.ai, click the request demo button, and someone on our team will get back to you, usually within 5 minutes.
There you go. All right, we've never done this before. I'm going to try to hand it off. See if you can share your screen and give us a quick tour of 4 degrees.
Awesome. I'm going to get my screen sharing. Let me know when you can see it. We should be off into the races in a moment. Seems like a little bit of a delay, but I think we're there. And sharing. Can you see?
Yep, perfect.
Awesome. So very quickly, so on 4 degrees, the way our product works is that it plugs into communication channels. So think email, think calendar. We can also plug into other kind of third-party systems where contact and otherwise relationship data may reside. We take the email address of each person and we build out a profile of that person. So think their picture, name, current roles, companies that they work for, etc. We actually then go and search the world for information about them, which is what you're seeing on this page. So if they've shown up in the news recently or published content, changed jobs, done new deals you should be aware of, we're trying to pick all that up and surface it to you. And we're doing that really with 2 main intents. Intent number 1 is that these are people within your team's relationship network that you find valuable. And this is just an opportunity to reach out and re-engage them, right? To this conversation that we've been having around elevating the conversation away from pure transactions to relationships. Here's an opportunity to go and do so and build on that relationship for the long haul. But then secondly, sometimes these notifications you're seeing here are signals for opportunities to engage on a potential deal together, right? And so for instance, if you were a Series C investor, knowing for instance that ENIAC just recently invested in the Series B of C Machines Robotics might mean that you would start to track C Machines Robotics and see if 6 months down the line that they were a company that were potentially worth you investing in. We actually do that a little bit more formally down here towards the bottom, where you can specify your areas of expertise and the stages in which you like to invest. And we'll both show you kind of deals that have been done recently that fit kind of your mandate, or at least the next round seems like it might. or deals that were done around 6 months ago that also kind of roughly fit that mandate, on the theory being that if a company is really rapidly expanding, they may be raising the next round 9 months after their first one. And so here's an opportunity to step in front of these companies and potentially start to get in front of them and win the deal before they actually go out to market.
You're 21 days too late on Pipe, by the way. It looks like in that reminder there.
Yeah, actually, yeah, I shot Harry a note. So yeah, it's funny that he's on the demo.
Yeah.
Real quick, I know we only have 1 other minute. So this is the kind of the underlying base of your team's network of interactions. We take the email address of each person as the base, as I mentioned, and then build out this profile you're seeing here. It allows you to search, filter, and slice this by a bunch of different dimensions. We find that our customers use this to, one, build out recurring cadences of interactions with deal flow sources they really like. So if you thought Leo was someone you wanted to touch base with once every 6 months, you can set that up in the system. We then compare that to the last time you interacted with them, which we pull in for you automatically and give you a view for if you're overdue to reconnect with them. And then secondly, you can search through this to find connection paths to specific companies. So let's say I was trying to find a way to get to Cameo here in Chicago, fast growing company. I do the search, naturally pulls up Steven, so someone we know directly there as a CEO, but also pick up all the folks you know who are investors in the business or advisors to it or former employees that you could all potentially use as a way of getting in the door. So I'll pause and hand it over to you.
Awesome. Love it. Let me do mine and we'll wrap here. Can you see my screen?
Yep.
Great. So for those that are new, this is our investor platform, really portfolio monitoring solution to let you get data updates from portfolio companies, but also in turn give them an experience to use our product for free to build relationships with their investors, potential investors, and our new fundraising CRM. So we kind of have this marketplace, if you will, of tools for both founders and investors. If I pipe into Visible here for a minute, you can see all of my different requests that have come through over time. And with requests, you can get qualitative information, quantitative information, and build reports for that, whether that's internal or external. So you can see here I have some core KPIs, cash balance, burn, headcount, total ARR, and net new. So you're able to customize metrics across the portfolio or on a per portfolio company basis, depending on maybe what that company does. If it's a SaaS business versus e-commerce, you can tailor those KPIs. And something new we just launched that I just want to highlight real quick while we're on the demo is our tear sheet builder. So one of the pain points we constantly hear from folks is, hey, I need to build a monthly or quarterly report, either internally for a portfolio review or externally for my LPs, and just building a way to automate this across the entire portfolio. So I'm in a template here. This is a PDF. Basically, the idea is let me export this to a PDF and collate somewhere else. So I have investment info, cash balance of the company. Up top, maybe I would do just a quick. Let's just do. Let's do total ARR. I'll add that chart in, and then let me get Zoom out of the way. I'll save this, and this will actually run and generate a template across all of my different portfolio companies where I can see cash balance of all my different companies. Matthew's not going to have any data. But Visible here will, and you can customize these, export to PDF. That's a new feature I want to touch on. But thanks for everyone for joining. Aborta, this was a true pleasure. I'm glad we finally got to do something professionally. This is fun. And if anyone has any questions, just reach out. Happy to answer those. We'll send this recap here when we're done.
Awesome. Thank you for having me.
Yep. See ya. Take care.
Yeah. Bye.